Hello, Jambo. Karibu tena to another session of Kurgat Eric Finance and Accountancy Tutorials. Today I'm going to take you through the partnership accounts. So in the business world, there are types of business organizations, and among them is the partnership accounts. We have the sole trader as the type of business organization. So the types are like, one is sole trader or sole proprietorship. This sole proprietorship, and we have the partnership and others. So you can see that partnership accounts is a form of business organization. The only difference between partnership and sole trader is because clearly from their terms. Like for the sole trader, sole means one. So this one is a business organization that is run by one person with the name of getting profits. So this person enjoys the profits of that organization alone. But when it comes to partnership, from the term partnership, this one clearly indicates that this one is a business organization where two or more persons come together, they contribute some capital, and then they invest that capital in that business known as the partnership business. And then after maybe a certain period of time, they now divide amongst themselves the profit according to the agreement that they made initially. So today I'm going to take you through the overview of partnership accounts. Overview. So the main aim of this session is to take you through the overview of what partnership accounts entail. So we have we have done a definition of the same, of the partnership accounts. So the next thing that maybe I will have to share with you is that this partnership business, since it is a coming together of more than one person, it means that they should have an agreement, right? So they should have an agreement. And that agreement is normally known as the partnership deed or the partnership agreement. So there are several things that the partnership agreements will stipulate, and some of them is, number one, the profit sharing ratio. The profit sharing ratio. That is, at the end of each and every financial year, or at the end of a certain period of time, these partners will share the profits as per the profit sharing ratio. So this one is a requirement by those who are registering partnership businesses, depending on the country that you are in. So in Kenya, you should have that partnership agreement that shows the profit sharing ratio. So let's say you have partner A and B, and then in the partnership deed or the agreement, it must show that at the end of the financial year, these partners are going to share profits in a certain ratio. So let's say partner A will get 3 and then the other one 2. That is a ratio. So that means out of the profits, we have KK as the profits of the year. So it means partner A will enjoy 3 over 3 plus 2 times KK. So this one is 3 over 5 times KK of the profits. Then partner B, on the other hand, will enjoy 2 over 5 of KK. So that is what I'm talking about when I say the partnership deed must show or must clearly tell the profit sharing ratio between the partners at the end of the period. So that is it. And then the partnership deed also, or the partnership agreement, should clearly show the interest on drawings. But before we look at the interest of drawings, let's look at the interest on capital. This is what I mean. For interest on capital, let's say, for instance, when these people are coming together to form this partnership business, and then partner A contributed maybe 1,000 Kenya shillings as capital to start this business, and then partner B contributed 5,000. Yes, so at the end of a certain period, then these partners may have to earn some interest on what they invested in. So it's like they are giving out some capital to start a business, and then they will require interest on that capital. It's like they are giving out a loan to start the business, and then the business also, the partnership business, should in turn pay them interest on that capital they have introduced. So the partnership business, the partnership deed or the agreement should clearly show the percentage of the interest that each and every partner is going to receive for the capital they have introduced. So let's say this partner A introduced 1,000, and then the partnership deed states that partner A should get 2% interest on capital. Then partner B should get also at least maybe 2%. So at the end of when preparing the financial statements of the partnership business, so it's important to calculate the 2% of the capital for partner A, and then 2% for 5,000 for partner B. So that one is a benefit to the partner at the end of the financial period. And I will show you how to treat this information in their respective accounts. We are going there. So the next thing to check on is the interest on drawings. Interest on drawings. So remember, these partners have introduced some form of capital into the organization. And we said that partner A may be introduced 1,000. Then partner B introduced, for instance, 5,000 Kenya shillings in form of capital. So this is what happens when it comes to interest on drawings, and I'll tell you who is enjoying this interest on drawings and which one is paying or who is paying. So the partnership deed or the agreement must clearly state the percentage of interest of drawings. Drawings, as you all know, from the format I gave you earlier in my earlier sessions on the formats of financial statements, to be specific, the statement of financial position or the balance sheet. We had that side of the balance sheet of the statement of financial position that the financed by part of the income statement. So it is for the statement of financial position. So this is just an extract of balance sheet. We said under financed by we have capital, maybe that figure, and then capital is normally reduced by drawings. You reduce drawings, and maybe you add net profit, or you less the loss. So it's either adding or reducing, right? So this is what we said. This is what we said when we were introducing the statement of financial position format. So as you can see, it's very clear that the drawings reduces the capital. So this one is the capital that was introduced by a sole trader. The same case, this capital of 1,000, 5,000 has been contributed by the partners. Yes. So in that case means that if a partner decides to draw some money from this capital, like what we've done here, drawings, reducing, so the company must charge this person or this partner a certain percentage as interest on drawings. It's kind of, the company is now starting to earn from the partner. This one, we must have a percentage, or the partnership deed must clearly state that the interest on drawing must be this rate or the otherwise. So for instance, partner A withdrew maybe 500 from his capital. So what will happen, and maybe from the partnership deed, the deed states that the interest on drawings is maybe 2%. right? So in this case, the interest on drawings will be 2% of 500, the withdrawn amount, which is 10. This 10, or the interest of 10, this interest on drawings is going to add, or rather is going to be charged by the partnership business, right? So this one is not a benefit to the partner, but instead it is a benefit to the partnership business. So that is what I mean. The same case applies to partner B. If he decides to draw some amount of capital, the partnership business must charge him or her a certain percentage as interest on drawings. So those are some of the things that you must be able to understand, and you get it right, because these are very common in the same. So again, the partnership deed must state the salary, the partner's salary, the partner's salary. So this is for the very active partners. So in most cases, the partnership business pays that very active partner for the dedication maybe he or she has in the running of the partnership business. So at the end of it all, or at the end of the year, the partnership business must pay this person some amount of money in form of salaries. And this one mostly is for those active persons. If you have two partners, A and B, maybe one of them will be earning salary because maybe he or she is active, is an active partner. So that one is just an overview of the partnership deed. Again, I want us to look at something else because we are still on overview. So at the end of the financial period, the partnership business normally prepares the final accounts, just like the way the sole trader does. So other things that we will look at in these partnership accounts and its arrangements are final accounts of partnership. Final accounts of partnership. And then we will also look at, just in partnership accounts, the changes in partnership business. Changes in partnership business. So let me start with the final accounts. Final accounts. Final accounts. Just the same way as the sole trader does. The sole trader normally prepares the financial statements, like the statement of or the income statement, the statement of financial position, cash flows, and so forth and so forth. The partnership also does so, but these are the most common final financial statements. So number one is the income statement. The income statement. So the main essence of opening the income statement in the partnership business is to arrive at either the net profit or loss. You arrive at the net profit or loss in the organization, right? And then number two, this one now is not in the sole proprietorship. This one is different. So it's known as the statement, okay, profit and loss appropriation. Profit and loss appropriation account. So this one is not in the sole proprietorship. I will show you how to go about. Then number three, we have the statement of financial position. The statement of financial position. Statement of financial position, or what is commonly referred to as the balance sheet, right? And then finally, I told you we have the income statement here, and we have another new account that's going to take over where the income statement will stop, and that is the profit and loss appropriation account. Then we have the statement of financial position. We are also going to break this on further by doing some adjustments on the finance by. Do you still remember the finance by, the format of the sole trader? we have that finance by section. So that finance by section is going to be amended here. We're going to change something, and some of the changes that we're going to affect are the capital accounts, right? So we have capital accounts and or the current accounts. So I'm just giving an overview of what is expected of us as we move forward with the partnership accounts. So these are some of the things that we're looking at. So maybe quickly I will explain this one by one. But from what you know, what you've understood from the books of the sole trader, we already looked at the income statement, how to prepare it. I also gave you the format of the income statement, where we said the income statement is an account that is prepared to arrive at either the net profit or the net loss in the organization. And then we also looked at the statement of financial position or the balance sheet. This one is the accounting equation, if you still remember, where the assets is equivalent to capital plus liabilities, the statement of financial position. But we'll have small adjustments at the finance by of the format of the balance sheet, and those adjustments are here, the capital accounts and the current accounts. I will show you this. So I know that what is now new to us is the profit and loss appropriation account and the capital accounts. So ladies and gentlemen, in our next session I will take you through each and every one of these accounts so that we get to understand it better. So until next time, it's goodbye for now.